2022 has been a year unlike any other seen in recent times, where equity markets had been tested to their very limits. Just as the world began seeing a post-COVID demand surge, global supply chain disruptions emanating from the crisis in Europe, and subsequent sanctions on Russia, led to a further breakdown. The result was historically high inflation levels, which were naturally followed by severe interest rate hikes. The subsequent outcome of all these factors was a brutal hammering delivered to stock markets across the world. With the US midterm elections finally over, analysts are hinting at a potential turning point for the markets, likely to proceed into 2023 and beyond. With the vicious interest rate hikes by the US Fed, many project inflation to begin its descent to normalization. Although the tensions in Europe are unlikely to end anytime soon, supply chain obstructions are on their way to being fully recovered. These factors point to a strong window of opportunity in the market to get hold of promising stocks before their inevitable price rally, as stability emerges in the markets. The stocks mentioned in this video are ideally primed to take off in the 2023 recovery that the markets strongly anticipate. The first stock on our list is the global diversified software company, Adobe Inc, which trades by the ticker ADBE. Adobe, having dropped from $690 to $330 in a single year, is a perfect example of a stock that took a beating this year, and therefore could enjoy a tremendous bounce back upon improving conditions. The company is a clear leader in the digital media space and faces booming tailwinds, given its positioning in the realm of cloud computing. Analysts report that the cloud computing industry is expected to grow by a compound annual growth rate of almost 16% from 2023 to 2030. Adobe is already enjoying the growth catalysts from industries adopting digitization and multi-cloud strategies. This explains the 23% top-line growth the company saw in 2021, and delivering revenue of $15.8 billion. Adobe has also been vastly enhancing its average revenue per user over the years, especially since the remote work concept took off in 2020, a trend that is only likely to further enter the mainstream. Given this trend, the company's most popular product line, Acrobat, has been seeing a considerable surge in subscription revenue, climbing by 13% in its Q3 results. Adobe's rise in 2023 is all but inevitable, and the stock is expected to see explosive growth, as consumer spending in the computing market goes through a resurgence. The second stock on our list is the emerging growth star, Hims & Hers Health Incorporated, which holds the ticker HIMS. The company is a high-growth telehealth player, which connects its clients to certified physicians through its digital platform, and then links them to licensed pharmacies following the prescriptions. This next-gen approach to healthcare gives the company an incredible value proposition, as patients are conveniently delivered a high-quality healthcare service from the comfort of their homes, using a simple yet engaging platform. Given the digitized nature of the entire experience, which trims massive overheads of physical clinics, the service is extremely affordable. Hims & Hers is operational in all 50 US states, and is on the verge of drastically scaling up. Its growth in the last 5 years has been incredible, with its number of subscribers jumping 530% to 1.3 million users. The company expects annual revenue for 2022 to close at over $510 million, which is leagues away from its 2018 revenue figure of $26 million. Despite heavy spending on marketing in recent years, HIMS expects to be EBITDA positive for the first time in its history, in the upcoming fourth quarter. Subscriber retention has been extremely favorable, standing at over 85%. The core reason for this is the multi-month subscription models, and an engaging application interface. The management is aiming on scaling up through product line expansion and acquisitions. With such a remarkable growth spurt, HIMS is trading at $6, which is surprisingly below its initial price in 2019 of $9.18, due to market panic. There is hardly a more solid growth player in the market than HIMS, which is still in its infancy. Buying this stock now would be the best investment decision for 2023. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. For number 3 on our list, we turn to look at Navitas Semiconductor Corporation, which holds the trade ticker NVTS. Navitas is not an ordinary semiconductor company, but one of the only that develops ultra-efficient gallium nitride semiconductors, otherwise referred to as GaN semiconductors. These devices ensure record levels of energy density, allow high-speed charging, and are being celebrated as environmentally sustainable, given their high efficiency. As a result of the revolutionary solution to its market, Navitas has been growing on full throttle. In its recent Q3 results, the company saw revenue climb 82% over the year to over $10 million. Margins have also improved drastically, to almost 40%, making the entity far more profitable than it was in recent years. Navitas holds over 120 patents in this proprietary domain of high specialization, making it the sole driver of a disruption that could take the semiconductor industry by storm. This allows it to charge through its target markets with ease, and accelerate its already rocketing growth. Its devices also have an immense total addressable market, with GaN semiconductor applications ranging across computer devices, chargers, solar systems, data centers, as well as electric vehicles. Above all, what is most compelling about Navitas is its phenomenal product quality, despite being the only player dealing with GaN semiconductors at this scale of operation. Through its rigorous testing mechanism, there have been 0 reported failures in its over 20 million devices shipped to clients. With such superior metrics, and for a company ready to disrupt a global industry, the stock has fallen significantly in the prior year. Due to market panic, NVTS has shed 73% of its price in the last year. This vastly enhances its growth potential, which could explosively be realized in the coming months. Next up, we take a look at the mid-sized fintech and cloud-based banker, SoFi Technologies Inc, which trades by the ticker SoFi. The company, despite all the bearish sentiments surrounding it, is giving its more conventional competitors a run for their money, even in the harshest of macroeconomic climates. Where some of the largest financial players, such as JP Morgan and Bank of America, saw their total deposits decline considerably this year, SoFi's deposits surged from $1.2 billion in first quarter, to over $5 billion in third quarter. Based on these trends, it is evident that forward-looking, cloud-based players such as SoFi are taking deposits away from traditional banking ecosystems. In its recent quarterly results, the company has continued its trend of beating earning estimates, and has raised its 2022 guidance consecutively for the third time. Revenue in the third quarter of $424 million was considerably higher than the $390 million target, and reflected a whopping 56% year-on-year growth. The company is also fast shrinking its negative EPS figures, which it projects to turn positive by 2024. SoFi stock fell by 75% this year, given the panic surrounding mid-sized banking players, as many thought them to be vulnerable, in comparison to the larger giants. The company, however, has been crushing the bear case, and proving with every quarter, that it was seriously underestimated. Short interest in the stock has thus fallen from $1.4 billion to $460 million at present. SoFi stock is a great one to hold, going into 2023, and is expected to undertake a long-term and sustained growth trajectory. The final stock on our list is the digital advertisement player, Digital Turbine Inc., trading under the ticker APPS. Digital Turbine presently holds an equity valuation of $1 billion, and operates a mobile growth platform. Its recent and most exciting offering is the single tap feature, allowing users to install an app displayed on an advertisement, through a single click, and functional on any browser. Its most recent licensing partner on the single tap domain is Google, with whom the company enjoys a strong business relationship. Digital Turbine also revealed an imminent partnership with the signing on of Amazon, for its e-commerce venture. Given the company's forward-looking business approach, a knack for innovation, and high-quality digital ad services, it has essentially turned itself into a cash generation machine. In its most recent quarterly results, Digital Turbine has successfully delivered an $11.7 million net income figure, against the prior year's figure of a $6 million loss. What is most remarkable is the fact that it managed to achieve this in one of the toughest macroeconomic climates, and shocked many in the market. For this reason, APPS stock rallied by over 60% in a single day, earlier last week. Moreover, the company hit an all-time high in its EBITDA margin by surpassing the 27% mark, and has set guidance for the next quarter at 29%. Digital Turbine has its sights set on the sky, and is aiming to sustainably scale up over the years. These initiatives could act as strong catalyst points for investors. One example is its alternative app store vision, where carriers or large brands could hold meta apps of their broader ecosystems. This is not a stock to miss out on, and is clearly a screaming buy. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for maximum and sustainable growth, entering into 2023. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.